What's up, guys? Thank you for tuning into Token Metrics TV and to my channel, The Quant Insights. This is Jad, the quantitative analyst at Token Metrics. Today, we're going to discuss structured products, and more precisely, structured products in the crypto space, of course, and all these new derivatives and decentralized derivatives projects that are opening up with very, very interesting products. So let's go ahead. And first of all, there's a few different projects out there that are developing these structured products. Already discussed Ribbon Finance a while back on our YouTube channel. And today I will also go a little bit and talk a bit about the strategy they provide. But also I'm going to talk about Squeeth, which is a very interesting new product available, which we spoke with and presented it for our premium customer a few weeks ago. And obviously there's a bunch of other projects that are tackling the structured products for crypto. There's Lemma Finance, which has very interesting basis trading strategies and things like that. These strategies are usually there to provide yield where there is ranging prices and things like very interesting aspects in the derivative space. So let's go ahead and discuss Ribbon Finance. So Ribbon Finance, like we discussed it a while back, they have I'm going to discuss two main strategies. They have an automated put selling strategy and they have a covered call strategy. So let's speak about the first one, the put selling strategy. So puts is an option. We already discussed a lot of different options in the past videos, so I'm not going to go into detail. But essentially, when you are short a put, if the price of the underlying, which in our case would be Ethereum, if the price of the underlying goes down below the strike price of an option, then you will start losing money because you're short that put. And if the underlying price goes up in value, you won't lose and you won't win any money. You will only cash in the premium, and that premium, you got it from selling the put from day one. So this is the payoff diagram of what a short put position would look like. It's a capped max profit, and the worst case loss is if the underlying goes all the way down to zero. All right, so let's discuss the risk profile of this automated put selling strategy. So the way it works is every week, Ribbon Finance in an automated fashion, they will sell a 15% out of the money put that has a maturity of 1 week, and they keep rolling this position. And you will be earning the premium by selling this put, and it comes in terms of yield. So a few benefits of this strategy is when you're selling options, you're benefiting from time decay. Time decay, we explained it in our previous options video. So if you're not familiar with options very much, I would suggest to go back and watch our previous videos on options. And the big risk in this strategy is if the underlying price, like Ethereum, goes down a lot, the put options are in the money, and then you will have to pay the difference between the strike and the current price. And the maximum profit each week is just a premium of that put in case that put finishes out of the money. So when is a good time to use this strategy is when you are bullish that a coin will not go down below the strike of the put option. So when you're bullish on Ethereum, it's good to collect a premium using puts. But don't forget the risk where if Ethereum goes down sharply, the put options will be in the money, and then you'll have to lose some returns for that. So here is the vault performance on the website of Ribbon Finance. Now, if you notice here on Friday, May 21st, so a week before Friday, May 21st, you had a positive cumulative return. But just that week, it was the top of the market where Ethereum really dropped sharply. And you went from positive 8% yield all the way to minus 12%. So this sharp drop in Ethereum during May produced losses in a strategy like this. But when there's not huge losses that are very fast, very volatile, the strategy is giving a consistent yield by selling these puts every week, as you can see in the right side of the chart. All right, so I went ahead and coded this strategy on a Python notebook just to see visually how it acts. So in black is the Ethereum price, and in red are the 15% strikes that you are rolling every single week. So every week you see, okay, this is the current price of Ethereum, and my strike would be 50% lower. And in case the price of Ethereum goes below that strike here, that's where you would lose money by selling puts. Like the best example, like we said in May, where there was this sharp drop, you can see the value of the puts in blue that skyrocketed. And since you're short, you will have to pay that value. So here is what caused the big loss. But as you can see, when there's no extremely sharp downturns, the strategy is very profitable. Like, for example, in this entire run-up here, in this case here, you would have lost a very small amount by being short puts. And all the way here, it's pretty profitable strategy, but the biggest risk is obviously these big drops. All right, so the second strategy in Ribbon Finance, they have evolved for covered call. So the covered call strategy comes in two components. The first component is that green line here, which means that you are long Ethereum. And the second component is selling a call option. And the payoff of selling a call option is the red line here. Here is the strike price. So everything above the strike price, you'll be losing money because you're short a call option. And then when you combine the long Ethereum plus a short call, you will get the payoff of the blue curve here, which looks extremely similar to selling puts, where on the downside, if price goes down, you will be losing. And then their maximum profit is capped. Everything above the strike, you will have a cap profit, which is the option premium. So the risk profile of the strategy, so similarly, every week, you are long Ethereum and selling a call option, which is 20% out of the money with a 1 week maturity. So you will get paid weekly premiums in case the calls are out of the money. Excuse me for the typo here. All right, so the risk of such strategy is that the call option will be in the money. Basically, since you're selling a call, if Ethereum goes up a lot, then you won't be making any profit. Your exposure to the upside is zero beyond the strike because you are long Ethereum and you are short a call, so they cancel out. It'll be zero, everything above the strike. And then on the downside, if Ethereum goes down, since you're long Ethereum, you'll be losing, but you will be up by the premium. So everything, you start at the premium, and then when Ethereum goes down, you start losing the premium all the way to negatives. All right, and also an important factor to consider, since you're long Ethereum, the Ethereum going down, you lose a pretty significant amount, which is not really mentioned in Ribbon Finance. And the max profit is the call premium, everything beyond the strike. So when to use the strategy, it's good to use the strategy when you're slightly bullish on a coin, when there's not a lot of volatility to the upside, because everything to the upside will be canceled out by a long and short call. All right, so let's see the performance. So here's the cumulative returns in terms of yield of this strategy. Now, they only show it since, I believe, September, so they don't really provide a long history for this performance, so we couldn't really see, but we'll see in my notebooks and backtest how it looks. And essentially, this is how it looks here. The strike is 20% out of the money, so it's pretty high. So it has a relatively low chance of Ethereum going above the strike and losing money in that case. Yeah. So here is coding it in a notebook. So here in green are the strikes of the 20% of the money calls, and in black is the price of Ethereum. So as you can see, the main losses in terms of selling these calls would have occurred here, where there was a very strong run up in Ethereum price. When Ethereum price went down, you didn't. The calls were out of the money, so you collected the premium, but you lost a lot on Ethereum because you were also long on Ethereum. So overview: the short put and the covered call strategies are best for bullish market conditions. They both are best when there's a low volatility, no huge jump in prices. And the advantages is that they earn you income in ranging market conditions in terms of yield, which is pretty good to diversify your long exposure. When prices are ranging, you want a strategy that is diversified, low correlation. So earning this type of yield could be a good idea, but it has risks involved, of course. Selling puts, if the underlying goes down a lot, that would be a big loss. And covered calls, since you're rebalancing long position plus short call option, it has high transaction fees. And of course, if the underlying goes down a lot, you want your premium to offset the loss in your long position. And here is just a plot combined. You can see the value of the calls in yellow and the value of the puts in blue. And here is the price, just for you guys to visualize these type of strategies. All right. So now the more interesting advancement in DeFi structured products is Squeeth. It's been mentioned a lot in the crypto space, especially in terms of the quants in crypto, because it's a very interesting and very innovative product. It hasn't been in traditional finance, but we can see it in crypto, which is very exciting. And it's been developed by Paradigm and Open. So you can trade it on Open. Unfortunately, in the US, you don't have access to it. So I couldn't show you a live trading. But let me tell you about the product, about the payoffs, and why it is so interesting. All right, so Squeeth is, like I said, it's a derivative product. It's similar to perpetual contracts, but instead of the index being the price of underlying ETH, it's indexed at ETH squared. So more details about that in a bit. And the thing is about options in DeFi, they lack liquidity. Few reasons for that, because options, regular options, they have strikes and they have maturities. So you have, let's say, 5 different maturities, 10 different strikes. So the liquidity is going to be fragmented by strikes and by expiries. So you won't have very, very strong liquidities. You can have a lot of volume at options that are close to the money, and very little volume for options that are far out of the money. So it's not very, very good yet. And you also need to think what strike you want to pick, what expiry, should I roll my position, and things like that. So here comes the advancements in this topic with everlasting options, which basically doesn't have expiry but still have strikes. So liquidity will still be fragmented. And here comes the solution with Power Perpetuals and Squeeth, where they put all the liquidity in one single asset or one single tradable product, because it doesn't have any strike and it doesn't have any maturity. So let's go a bit deeper in the Squeeth product, and let's compare the payoff of Squeeth compared to being long 2x leverage or just a regular call option. So first of all, the payoff of the long Squeeth is convex. You're going to hear a lot of convexity in that term if you do some research on that. But essentially, it's about the curvature. It's about more upside and less downside. I will explain a bit more. And the difference, the very nice difference between being long Squeeth and 2x leverage is that if you're long Squeeth, you cannot get liquidated. You will only lose all your investment if Ethereum goes down to 0, compared to leverage where you can get liquidated on a long position. And similar to perpetual, there is a funding payment that is continuous, and obviously there's no expiry, so it's perpetual. All right, so compared to option, Squeeth doesn't have a strike, doesn't have expiration, so liquidity will be consolidated, it won't be fragmented, you won't need to think about rolling your positions, and things like that. And a very interesting and nice aspect of it is that it has a constant gamma, so I already spoke about gamma, but we'll speak a bit about it later. Compared to perpetuals, on the long side, there's no liquidations, but if you're short Squeeth, you can get liquidated. We'll talk about that. And compared to a 2x leverage, you can make more on the upside and lose less on the downside. So that's pretty nice, but obviously there's no free money in the markets, except maybe airdrops. But in this case, since you have more upside and lower downside, then you'll have to pay for that. And that payment comes with higher funding payments than perpetuals. So here's the aspect of convexity, and here's why this product is very interesting. So in red is a 2x leverage long Ethereum, and in blue is the Squeeth, so Ethereum squared. So the nice thing is the convexity here, which essentially says that on the upside you can make more, and on the downside you lose less. Notice here that if you're 2x long on Ethereum, a 50% decrease in Ethereum, you would be completely liquidated, so you'd lose everything. Compared to being in Squeeth, you would lose around 70% of the price. Drops by 50%. And opposite, on the upside, if Ethereum goes up by 100%, if you're 2x long, you will make 200%. But if you're Squeeth, you will make 300%. So more upside that we'll discuss. Some characteristic, I don't want to go a lot of details, it gets too long. But essentially, it's very similar to perpetual. You have an index price, which is Ethereum squared. You have a mark price, which is the price of Squeeth based on supply demand of this product. You have a funding rate that goes from the longs to the shorts, which is related to the discrepancies between the index and the market price. And the funding mechanism of this product is different than perpetuals. It's called an in-kind funding. It's not an interest payment. It essentially reduces your position if you're long automatically in your oSQTH position, and if you're short, you will be losing. You will be reducing the debt that you owed when you went short in that. And the actual token is an ERC20 token. It's oSQTH, O for open, similar to CUSDC, like Compound and things like that. And that is the value of your position, and it includes the impact of funding and all. And they have a normalizing factor, which is essentially what allows your position to change with time due to funding and due to changes in Ethereum. So if you're long, the value of your position will be reduced continuously because you're paying funding. And if you're short, you'll be earning the funding, and that will take out of the debt that you own by going short. All right, so let's go through an example of being long Squeeth. So like I said, unlimited upside because it's ETH squared, no liquidation, you pay consistently a funding fee. It offers convexity because it has more upside than 2x leverage ETH and less downside than 2x leverage. And due to that attractive component, the funding will be larger because you need to pay the shorts for taking that bigger risk than you are taking as a long. So you have to pay for that. All right, so here, the best case to go long Squeeth is if you believe that there's going to be a very strong upward move in Ethereum on the short term. And I say short term because if you're holding for too long, you're going to be paying a lot of funding, and it will reduce your exposure to upside continuously. So if you look at this chart here, and if you look at the blue line, which is this Ethereum squared, and the yellow line is the oSQTH, which is the value or the mark, the value of the Squeeth contract. And as you can see, the more you hold this contract, the lower your exposure to upside because of that funding payment. So in my opinion, it's best to use this type of contract for a month, 2 month, maximum of a 3-month period. All right, so here is an example detailed of how a long Squeeth trade would look like. So I'm going to go a bit quickly. Consider Ethereum as being traded at $450. You want a long Squeeth, and you want to put 10 Ethereum worth of a long Squeeth position. So your entire position will be worth 4,500. And with that 4,500, you will be able to get 222 oSQTH because the price squared of Ethereum is 202,000. And here's the calculation just for you. So essentially, your long exposure and Squeeth will be 4,500, the value of 10 ETH. Very simple. So let's say after a year, Ethereum went up to 4,300, so almost a 10x. So Ethereum price, if you were long Ethereum, would have made 10x. If you were 2x long Ethereum, you would have made 20x. But if you were long Squeeth, the Ethereum squared, the index price went up by 90x, almost 100x because it's squared. But the value of your contract went up by 50x because the difference between 90 and 40x is the funding that you're paying for a whole year. So that's pretty important. So that's why this product is very attractive. Much better risk reward than being 2x leverage. All right, so here is just what convexity means. Essentially, a convex function is a curvature like this, where the slope is increasing. So on upside, you make more with the same movement, and on downside, you make more with the same movement. It's essentially a nonlinear relationship with an asymmetry. Better upside than downside. But if there's better upside than downside, then it's going to be expensive, which is the funding payments. All right, so here's a few technicalities of the funding rates, the in-kind funding, which I'm not going to go in a lot of detail right now, but here it is for you if you want to delve deeper. And oSQTH is the ERC20 that is minted when you want to buy this contract, and the value of oSQTH reflect the changes in Ethereum and the funding payment that you keep doing. All right, so now let's flip it. If you are short Squeeth, which is more risky, if it's more risky, then you need to be compensated for that risk, and that compensation comes from pretty significant funding payments. All right, so you will earn funding payments from the longs if you are short. In that case, you can be liquidated. If Ethereum goes up a lot, you will lose your collateral, so you can get liquidated if you are short. And since you're putting collateral in terms of ETH, you would still have exposure to upside for ETH. And it's a little bit similar to selling at the money straddles continuously. So here's what selling a straddle looks like. And if you can notice, is it makes most money when the underlying doesn't move too far from the current price. So it's a short volatility trade if you'd like. The recommended collateral is 200% because it's pretty risky to be short this instrument. The best market condition, like I said, is if Ethereum doesn't move too much, so in a range-bound environment, and if you believe that volatility is overpriced by the market participants. And since you can get liquidated here, your maximum loss is the entire collateral that you put in to mint and sell the Squeeth. All right, so to do the short Squeeth, you put down Ethereum as collateral, you mint oSQTH on the open website, and then you can sell your Squeeth on Uniswap, and that way you'll be short the Squeeth contract. Now, this is what your cumulative return can look like when you're short Squeeth. So since you're short, you will be earning funding, which is represented in the red line here. And in blue is the price change of the Ethereum squared. So here, Ethereum squared is going up in value, but slowly. So the main point of being short, you want the funding payments to overset the increase of Ethereum price. So if the funding is higher than the increase in Ethereum, that's where you make money. All right, and here is a short example of what it looks like when you want to short Squeeth. If you believe that volatility is overpriced and you think Ethereum will be ranging, then it's a good idea to short Squeeth. And in that way, you will be earning funding, and they give you usually the funding rate. And then you will get, depending on how much collateral you put, you will get a portion of that Squeeth contract. And then there's two factors to consider. First of all, the delta, the change in Ethereum price. So if Ethereum goes up, since you're short this contract, you will be losing some money. And here you can check the numbers, how they look like. But you will be earning funding because you're short this contract. So the most important thing is you want the funding payments to offset the loss if Ethereum goes up. All right, and this is what we discussed. So even if Ethereum goes up with a significant amount, like 100% increase in a few months, if there wasn't a very strong spike in volatility, then the funding payments would have offset that 100% gain. So you would have made money in that case. All right, and an important aspect, an interesting aspect, is that there's something called path dependence, essentially showing that it really depends where you are today in terms of your cumulative return. So here, the two plots are a short Squeeth cumulative return scenario. Both of them have the same entry and same exit points. The only difference is that in this case, there wasn't a lot of volatility in terms of the price change of Ethereum. In that case, there was strong jumps in the price of Ethereum. So if volatility was pretty high, this is where you lose. And you lose because if something goes down 50%, it will need 100% to go back to where it was. So it shows you here that if there was a significant drop, you're already down here. So you would need very strong returns to go back to where you were. So here's the difference between a low volatility environment and a high volatility environment in terms of a short Squeeth. So the short Squeeth is essentially a short volatility instrument. All right, and the nice thing about these advancements is that you can start building automated strategies by using Squeeth. A very nice strategy that will be live on Open next week is the crab strategy. They call it crab because it's best for ranging environments. So the way this works is it's a vault, automated strategy. So you will only get paid in yields, but it combines two aspects: a short Squeeth position with a long ETH position. So we'll be long one ETH and short one Squeeth, and the short Squeeth will get you funding, and the long ETH will offset the loss when you short the Squeeth, so that you will be market neutral. So you won't have a lot of effect on the Ethereum price itself. And it's a short volatility strategy because it works best if the underlying Ethereum doesn't move a lot. And it's similar to selling the straddles that I mentioned before. So it's profitable as long as Ethereum doesn't move too much, and as long as it moves less than the funding payments that you are getting. And this strategy, essentially, it's assuming that you believe market participants are overpricing volatility. They believe that volatility is very high, and I believe that volatility will be low. So this specific strategy will be very good to do. All right, so it's been a bit technical video here, but it's a very interesting topic for me, and I hope you also are interested in option strategies and these new advancements in structured products in crypto. So I hope you enjoyed this video and more content like this next week. So thank you and see you next time.